The Intelligent Investor by Benjamin Graham is a timeless guide to investing with logic and discipline. First published in 1949, it remains one of the most influential financial books ever written. Graham teaches that the key to success in the stock market is not brilliance, but emotional control and rational thinking. The book introduces two main types of investors: the defensive investor and the enterprising investor. The defensive investor values safety and simplicity. They invest passively in a diversified portfolio and avoid speculation. The enterprising investor, on the other hand, is willing to do more research and take calculated risks to achieve better returns. Both approaches can work if they are grounded in discipline and long-term thinking. Graham's most important idea is the concept of intrinsic value, the true worth of a business based on its earnings, assets, and growth potential. The intelligent investor buys when the market price is below this intrinsic value, creating a margin of safety. This margin protects against mistakes, market volatility, and uncertainty. He introduces the character of Mr. Market, a metaphor for the stock market. Mr. Market offers prices every day, but his mood swings wildly between optimism and fear. The intelligent investor does not get carried away by his emotions. Instead, they take advantage of his irrational behavior, buying when prices are low and selling when they are high. As Graham explains, the market is there to serve you, not to instruct you. The book also distinguishes between investing and speculation. Investing is based on careful analysis and focuses on safety of principal and adequate return. Speculation is short-term gambling based on predictions. Graham warns that many people lose money because they confuse the two and let emotions drive their decisions. For defensive investors, Graham recommends diversification and balance between stocks and bonds. He suggests keeping 25% to 75% in each, adjusting based on market conditions. They should invest in solid, dividend-paying companies or low-cost index funds. The enterprising investor, however, can search for undervalued stocks companies that are temporarily overlooked or misunderstood by the market. Another central principle is the margin of safety. By purchasing stocks at a significant discount to their intrinsic value, investors reduce their risk and increase their potential reward. This concept applies not only to stocks, but to all investment decisions. Graham also emphasizes patience and the long-term view.